Howdy, everybody. Welcome to Liberty Call. Today is Monday, January 29th, 2024. Hope everybody's having a fantastical day out there. Need to spend a special shout out to my oldest boy, Ryan. He is 34 today. So he is he's my stepson. So I've been around since he was 5. So he's pretty much mine at this point. So anyways, happy birthday, Ryan. I know you don't watch this, but if you do go back, you can see I said happy birthday. So anyways, hope you enjoy your gift. All right. So like I said, it is Monday. It is a beautiful day here in Colorado. Sun is out. Sky is clear. It's not too cold, but there is still some snow in my front yard. But I did have to break out the snowblower on Saturday, unfortunately. But it wasn't too deep. It didn't take too long. So anyways, if it is your first time watching Liberty Call, you can see my boy Jake back here is excited because as soon as we're done, we're going out to play some ball. So like I said, if it is your first time watching Liberty Call, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. As you can see, I got all my painting done, so my office is back together. Let's go ahead and get into today's numbers. All right, Dow Jones was up 0.59%. Was in the red for a little while. Closed at, it was up 223 points, closed at 38,333. The SP 500 was up 0.77%, closed at 49.28. NASDAQ was up 1.12%, closed at 15,628. The VIX was also up today, 2.87%. It's at 1364. Canada was up 0.36. Brazil was down 0.39, and Mexico up 0.52. Over in Europe, Germany was down 0.12, the UK flat down 0.03, France up 0.09, the Netherlands up 0.27, Spain down 0.47, Italy down 0.48%, Switzerland up 0.35%, and Portugal down 0.36. Russian exchanges both in the green today, the MOEX up 0.52%, the RTSI up 1.46%. And the overnights, the Nikkei in Japan was up 0.84%, Australia up 0.3%, New Zealand down 0.22%. In China, the Shanghai was down 0.92%, the Shenzhen component down 2.06%, China A50 down 0.35%, DJ Shanghai down 1.09%, Hang Seng up 0.78%, and the Taiwan weighted up 0.69% for the day. So kind of mixed across the globe. I'm not sure why ours took off here in the last hour or so, but guess everyone's in a good mood as the markets came to a close. All right, let's go ahead and move over to the weekly economic update. All right, stocks continued their upward climb last week as excitement around big tech continued. Positive economic report stoked investor belief that the Federal Reserve has pulled off a soft landing. And if you believe that, I got a bridge somewhere I can sell you. All right, stocks power ahead. Big tech was back last week, pushing the Dow and the S&P 500 to new highs in early in the week as markets resumed the late Q4 rally. The so-called Magnificent Seven stocks, comprising 28% of the S&P 500 index, resumed their pole position at the head of the pack as investors maintained their artificial intelligence-related bullishness and rewarded widespread cost-cutting at many tech giants. While the rally fizzled on Friday, last week's gains were slow but steady. The big economic news last week was the better-than-expected economic growth and inflation news. Real gross domestic product grew at 3.3%, annualized clip in Q4 of 2023, ahead of the Wall Street consensus expectations of 2%. The Personal Consumption Expenditures Index, one of the Fed's most favored inflation gauges, showed core inflation, excluding food and energy, cooled in December with an annualized rate of 2.9%. That's still nearly 50% more than what the Fed would like as down at 2, beating the consensus expectations. Core inflation was 3.2% on an annualized basis, its lowest level since March of 21. While the inflation update didn't move markets much, it helped validate investors' optimism that the Fed policy has maintained economic growth while bringing inflation down. All right. Earnings season feeds FOMO. The market digested Q4 earnings news from some of the largest companies with enthusiasm feeling like fear of missing out. The fear of missing out drove much investor sentiment and seemed to build market momentum. While the enthusiasm for AI continues to be one driver of technology stock prices, the spotlight last week was on layoffs. Over 23,000 workers at 85 tech companies have lost their jobs this month. The market appears to be rewarding the cost-cutting measures, with many tech giants repositioning themselves with AI in mind, and some analysts inferring that the emphasis on efficiency may encourage investors. All right, economic data this week. Tuesday, we have the Federal Open Market Committee meeting, the Fed meeting. Also, consumer confidence and the home price index. Wednesday, we have the FOMC announcement and the Fed chair press conference. Thursday, jobless claims and the ISM manufacturing index and Fed balance sheet. And Friday is the employment situation. Got a handful of companies reporting earnings this week. Tuesday, we have Microsoft, Alphabet, UPS, and Starbucks. Wednesday is MasterCard, Boeing, and ADP. Thursday is Apple Computers, Apple, Amazon, Meta Platforms, and Merck. And Friday, we close out the week with ExxonMobil and Bristol Myers. All right, so that is our weekly economic update. Pretty exciting stuff, huh? You can see Jake, he is like on his edge of his seat right now. He can barely keep his eyes open. All right, let's move over to today's market recap. U.S. stocks climb as big tech shows strength ahead of earnings. All right, U.S. stocks experienced gains on Monday as investors displayed bullish sentiment towards the tech sector ahead of major tech companies' earnings releases. The ongoing dominance of tech stocks was evident as key players, including Alphabet, Microsoft, Apple, Amazon, and Meta Platforms, are set to report earnings during the busiest week of the earnings season. Alphabet and Microsoft are scheduled to announce results on Tuesday, followed by Apple and Amazon on Thursday, with Meta Platforms concluding the week on Friday. SoFi Technologies also saw a substantial 18% surge after its fourth quarter results surpassed Wall Street estimates. However, iRobot faced a setback, declining by 10% as the robot maker and Amazon mutually agreed to terminate their acquisition deal. The positive trend in the tech sector was supported by a decline in Treasury yields, creating a favorable environment for investors awaiting key macroeconomic data later in the week. The Federal Reserve's two-day policy-setting meeting, commencing on Tuesday, will be closely watched for any updates or clues regarding rate cuts. While expectations for an unchanged decision on rates are priced in, investors are eager for insights into the Fed's outlook and policy decisions. Some analysts anticipate a March rate cut, emphasizing the importance of data-dependent messaging from the Fed. Looking ahead, market participants are anticipating the widely watched monthly payrolls report on Friday. In addition, key economic indicators such as the jobs openings, consumer confidence, private sector payrolls, and weekly data on initial jobless claims are scheduled for release throughout the week. Consumer stocks received a boost as Tesla rebounded by 3%, attracting dip buyers despite lingering concerns following the company's recent quarterly results missing Wall Street estimates. Cruise stocks, including Royal Caribbean Cruises, Norwegian, and Carnival Corporation also contributed to positive momentum in consumer stocks, with Carnival Corporation experiencing a nearly 4% increase. All right, so all in all, things are pretty decent today. So, I mean, there's always tomorrow, but all right, one last article here comes from our friends over at First Trust, Mr. Brian Westbury. This week's article is titled A Stock Market Conundrum. Let's see what he had to say. All right. Brian Westbury provides an economic overview emphasizing the robust growth of real GDP at 3.3% annual rate in the fourth quarter. Consumer spending remained strong in December, contributing to a positive start for the first quarter. New home sales exceeded expectations and initial jobless claims remained low, indicating overall economic health. However, the focus shifts to the upcoming jobs report with an anticipated gain of approximately 170,000 jobs and a steady unemployment rate. Despite these positive indicators, Westbury expresses concerns about the fragility of employment growth, excluding certain sectors heavily influenced by government funding and pandemic-related effects. Job growth appears notably weak, raising questions about the sustainability of recent economic expansion. The stock market continues to rally, reaching new record highs, but Westbury is cautious about the market's expectations. The discrepancy between the market's anticipation of a significant rate cut by the Federal Reserve, 125 to 150 basis points, and Westbury's skepticism suggests potential headwinds for equities in 24. Westbury questions the conditions that could lead to such a substantial rate cut, pointing to the possibility of either a sharp drop in inflation or a decline in economic growth. However, both scenarios are viewed as unfavorable for the stock market, potentially signaling lower corporate profits. The capitalized profits model, based on economic-wide profits discounted by the 10-year Treasury yield, suggests that stocks are overvalued. Using the model with third quarter profit levels and a 10-year yield of 4%, the fair value of the S&P 500 is estimated at about $3,900, well below recent highs. To align recent stock prices with appropriate valuations, Westbury suggests a 10-year yield of about 3.2% or a 30% increase in profits. However, achieving those scenarios poses challenges, leaving fair value seemingly distant. Westbury notes that only a miraculous boost in productivity through technologies like artificial intelligence could provide a way out of the current economic conundrum. In conclusion, Westbury advises caution to investors, noting that the monetary and fiscal stimulus that mitigated the economic impact of COVID-19 is waning. All right, so I mean, yes, all the data looks good now, but looking forward, it does not look real great. Plus, again, we've had the yield curve inverted for a year, maybe more. I'd have to go back and look at when it actually flipped. So, I mean, there's a lot of bad news out there. I mean, you just have to know where to look. I mean, granted, the folks on the TV and places like that aren't going to say anything because, ratings are ratings, and they, making people feel nice is unfortunately the situation right now. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. On my contact information there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.